Hello everyone, my name is Madeline Dolgen. Today I will be sharing the results from a financial analysis conducted on the global education company Pearson, who ranked number 15 on the Forbes list of the 100 most sustainable companies. Our agenda for today is an overview of the company, its mission, business units, industry position, and strategic goals. Then we'll explore the economic implications of social and environmental issues that impact its industry as a whole, as well as the specific company. Discuss the company's financial health based on a financial analysis conducted from its last 3 operating years. Then compare the company's financial performance to competitors within its industry. And then finally provide recommendations for improved wealth management. So who is Pearson? Many people today recognize the name Pearson from their school textbooks. Pearson originally began as a book publisher and was once considered the largest publisher in the world. Over the years, Pearson has branched out into more products than textbooks. In 2017, they began a restructuring plan to consolidate their business to focus on leading the way in digital learning services. In 2019, they announced they would be slowing their publishing of physical textbooks, moving towards developing e-textbooks instead. Today, they provide a range of digital tools and educational services to a variety of stakeholders all over the world. Pearson is truly a global business whose mission is to empower people to progress in their lives through learning. Their vision is to enable this mission through having direct relationships with learners to support them through a lifetime of learning and equip them with the skills and knowledge they need to become employable in the 21st century. These guiding principles are achieved through aligning their businesses to meet the needs of today's diverse learners in innovative and accessible ways. They work with a variety of stakeholders, from schools, colleges, and students. Their products and services consist of global online learning, which is virtual schools and online program management, global assessment tools like International 1 English language exams and digital assessments, and finally, U.S. higher education coursework, which includes e-textbooks and digital tools, such as their newest product, an AI digital calculus tutor that can be downloaded as an app. They continue to innovate in the digital product space as well as online program management. Through their products and services, their main goals are to deliver value to their 7 stakeholder groups, which include employees, their authors, learners, customers, partners/suppliers, channel partners, and government. They identified 3 strategic priorities over the past year for their business as a whole. 1, grow market share through digital transformation. 2, invest in structural growth opportunities. And 3, become a simpler, more efficient, and more sustainable business. As a leading global education company, they play a large role in contributing to the Sustainable Development Goals. They have identified 3 SDGs that are material to their stakeholders. Number 4, high-quality education. Number 8, decent work and economic growth. And number 10, reduced inequalities. At the end of 2020, they published their 2025 sustainability strategy, a 5-year plan with measurable targets to further integrate sustainability into all aspects of their business. The education in general is incredibly diverse and populous. There are hundreds of companies operating in the space. The global education market itself was valued at $4.5 trillion in 2013, and it's expected to hit 9 or 10 trillion by 2020. Pearson has only a fraction of that. Among its most direct competitors, though, Pearson holds the number 1 or number 2 spot in all of its product markets. Pearson has maintained its position as the largest textbook publisher for several years. Overall, publishing and education companies have been facing serious revenue losses due to a surge in popularity of the secondhand textbook market, including reselling and renting. Many education publishing companies have been working towards a transition to digital first instead of print textbooks to reflect these challenges facing their industry. It is Pearson, though, that has risen as the market leader, as they have been the first to scale and launch a digital-first strategy, making them leaps ahead of their competitors as they capitalize on this new era. Larger macroeconomic factors have hit the education industry in its entirety. As mentioned earlier, students are no longer reaching for physical textbooks. There's also been a steady decline since 2001 in the number of students going to college due to a booming economy, which has meant less consumers in the industry as a whole and less institutional partners, as some private universities have been forced to close due to low enrollment numbers. It seems Pearson has risen to these challenges, having just completed their restructuring plan in order to double down efforts on the transition to digital. The benefits of restructuring are supposed to turn around the effects these macroeconomic impacts have had on education companies and capitalize on new high-growth markets that better align with the needs of students, education institutions, and employers alike. Pearson's shift into online program management continues to grow as more students are finding the flexibility of online learning allows them to balance work and school. COVID-19 has actually had a positive effect on the digital aspects of the education industry. It's also led to increased demand for online learning. Another key challenge for the industry as a whole is public perception. Corporate education companies like Pearson have been under criticism for a while. Many people are concerned about the impact of privatization of public education, particularly around how these companies store large amounts of student data and have the potential to influence educational institutions to adopt more market-based approaches with their relationships to students. For example, Pearson and several of their competitors are actually facing a potential class action lawsuit on this subject. Litigation is over a business model called inclusive access, where these corporations sell bundles to colleges to access their digital courseware. This limits student flexibility in where they want to purchase their books, and they're also unable to sell back their textbooks because it's simply a digital access code. The lawsuit argues that these programs violate antitrust laws, and they also see it as an act of collusion between corporate publishers to control the market and push out competition from secondhand textbook markets. Pearson fully intends to defend itself against the allegation and stands by the benefits of their inclusive access model. As a company driven by a sense of purpose, as CEO John Fallon says, sustainability has become increasingly important to Pearson, and so they have embedded their sustainability strategy throughout their entire business. In 2019, they conducted a materiality matrix with data gathered from a stakeholder survey and interviews. The 8 areas shown were deemed the most important priorities that overlap between the business goals and their external stakeholders. These 8 priorities will guide their 2025 sustainability strategy, which includes advance equity and learning, build skills for sustainable futures, and lead by example. From the standpoint of Pearson's board, integrating ESG across the company is an important way to drive growth, manage risk, and reduce costs, all of which can have significant economic benefits. For more on their 2025 sustainability strategy, visit pearson.com/sustainability. As a digital-first company, their direct environmental impacts are limited in comparison to companies who impact the natural environment daily. Despite this, they still express a commitment to continuously working to better understand their environmental impacts and reduce where possible. They recently conducted a life cycle assessment of one of their global education programs with the organization TrueCost. TrueCost said this was the first LCA of its kind to evaluate an education program. The consulting company McKinsey reinforces the benefits of ESG. Their research conducted on hundreds of sustainable companies determined that sustainability programs are not just strongly correlated with good financial performance, but also play a role in creating it. There's been additional research showing the benefits of incorporating these types of ESG factors into business. Companies that factor in ESG are less likely to go bankrupt, they have a lower cost of debt to equity ratio, and overall outperform their markets. There's also a clear correlation between resource efficiency and financial performance and better risk management. As we move into the financial analysis of Pearson in comparison to the industry and its competitor Cengage, we will see that Pearson has performed well in these financial ratios. Coincidence? I think not. For the most recent fiscal year, which ended in 2019, net sales have been trending down by another 6% last year, mostly due to the decrease in popularity of physical textbooks, as well as the portfolio changes during the restructuring plan. There was much quicker decline of physical textbooks than accepted. There was still growth in Pearson's other markets, core and growth, due to good sales. In the past year, underlying revenue continued to be flat, as with the past several years, but overall operating profit was still up by 6%. Net debt increased modestly, primarily reflecting acquisitions and disposals. But over the past 3 years in general, net debt has been trending down. Lastly, the dividend has been steadily increasing. The board proposed a higher dividend than last year due to increased earnings per share and overall growth, which is a good sign. In terms of liquidity/efficiency, over the past 3 years, Pearson received significant benefits from their restructuring plan, significantly lessening their operating expenses and lowering their liabilities, leading to a strong ratio of liabilities to assets and therefore a strong balance sheet. The cost savings from restructuring was reinvested back into the transition to digital. A high current ratio of 1.86 shows that sales have gone down more than their assets, so this does mean they were less efficient at using their assets this year. For solvency, Pearson's liability and equity has not changed too significantly over the past 3 years, but the overall debt-to-equity ratio does show a decrease since 2017, which shows that they are getting better at managing debt and have decreased it over time. In terms of profitability, net sales have been trending down by another 6% last year, mostly due to the decrease in physical textbooks. There was a much quicker decline than expected. Overall, sales and profit margin have declined over the past 3 years, likely due to the decrease in demand for physical textbooks. In better news, the operating expenses have decreased significantly as part of the restructure. The hope is that investment into high-growth markets and digital will more than make up for the loss of revenue from textbooks. As a leaner business, they can spend less money and hopefully improve profit margins. Lastly, as a market prospect, Pearson has grown its earnings per year by 6.6%. The price per earning has consistently risen, but it is still overall low. It's probably not due to net debt because this is pretty low, so it's more likely due to cash on hand, which has impacted this low P/E. In comparison to two of Pearson's competitors in education, print and publishing, which includes Cengage and Wiley Education Services, Pearson stands out. Pearson's quick ratio of 1.84 and return on assets 3.49 are high, meaning that Pearson is using its assets better than its competitors in the industry in general. Concerns lie in their cash flow. The cash flow ratio at 0.31 was still higher than the industry rate, but lower than their competitor Cengage. Pearson should work on making more cash assets over the next fiscal year. A good current ratio is between 1.2 to 2. Pearson is fairly liquid, with a current ratio at 1.94. In terms of profitability, Pearson's debt to equity and total debt to assets are also much lower than their competitors, although higher than the industry as a whole. Debt has been a significant challenge for this industry. In 2013, Cengage filed for bankruptcy. Cengage continues to have high debt ratios, showing concern over how they manage their debt. In terms of market share, Pearson's price per earnings ratio has risen significantly over the past year, making it close to and on par with Wiley and the industry average. This is likely due to Pearson's increase in earnings per share. If they had a bit more cash on hand, this ratio could be improved. Overall, Pearson crushed the industry with net income having positive earnings this year. Wiley and Cengage both were negative. This seems to be a reflection of Pearson's move to digital to capture more market share than its competitors. In summary, Pearson has been performing well overall. Pearson's success seems to be attributed to their innovation, consistently ahead of the curve, as reflected in their leadership in transitioning to digital first. This has helped them accomplish 2 out of 3 of their strategic goals. 1, to invest in structural growth and opportunities, and goal 3, to become a simpler, more efficient, and more sustainable business. They have yet to see the upturn from the last goal to grow market share through digital transformation, but the trajectory looks promising. They are also the only company amongst their top competitors to have a robust sustainability strategy, which includes rigorous reporting, performance management, and financial incentives tied to sustainability goals, as well as a larger business strategy built on their commitment to the SDGs. They seem to be the first to go beyond corporate philanthropy and lead buildings by reporting to larger international frameworks. It seems Pearson is both the leader in terms of financial market share and corporate responsibility. In terms of their financial performance, the outcome of their restructuring plan was good. It has allowed them to simplify their business to better focus on the products and services where they excel the most. It has also benefited them by cutting costs, helping them move towards a stronger balance sheet. Moving forward, they are in a good place to grow through reinvesting profits from cost savings into new products and services, helping them to grow more organically. They expect to see underlying profit growth for the first time in the past 5 years during this next fiscal year. One of the major risks facing them is the possibility of the shutdown of their open access courseware, which is currently pending legislation. So finally, as far as recommendations, after a rocky period which began in 2016, Pearson's valuation is looking promising again. Overall, Pearson appears to be on a trajectory to increase their dividends, with expected increase in profits from their new digital strategy. It will be important that they continue to adapt to the changing needs of customers in the education market in order to maintain their lead in market share. Although the restructuring plan has led to improved balance sheet, at present it is hard to determine if their restructuring plan and transition to digital will be enough to drastically increase revenues and therefore dividends. This leads me to my recommendation 1. Pearson should be especially diligent about analyzing the financial results of the digital space to ensure that they are targeting the right markets to continue to hold market share and increase revenue. Another challenge is that digital courseware has much lower profit margins. Therefore, they must quickly expand access and gain new customers in order to make up for the loss of their physical textbook business. Digital textbooks only sell for 50% of the cost of physical textbooks due to the customer's knowledge of less overhead. The expansion into digital will need to be enough to make up revenue losses from the price points of their physical textbook businesses, which they have now disposed. For recommendation number 2, the pending legislation seems to be one of the biggest threats. In order to make their case, they must continue to invest in partnerships with students to show support for the benefits of their product. If this business model is banned in the US, they will be at risk of losing a significant amount of revenue. Currently, 2.9 GBP worth of sales are made in North America, while their core and growth markets make up just 1.5 billion GBP of sales. So the US is a significant asset to their business, and open access courseware is a major component of that revenue. Lastly, for recommendation number 3, Pearson should capitalize further on their investment into sustainability initiatives by creating an environmental profit and loss statement. This will capture the financial impact of their sustainability strategy, which can serve to positively boost their reputation and trust from both the public and their shareholders. This trust may also help when faced with the pending legislation and ensure that they continue to have a profitable and sustainable business for many years to come. Thanks so much for listening, and I hope you have a great night.